Good morning and welcome to the Killik & Co market update. We've seen fairly big moves in the oil price this week following a strike on Saudi Arabian oil refining facilities. Initially, the strike was thought to have taken out about 5% of global oil supply, and therefore in the early hours of Monday morning we saw a 20% spike in the price of Brent crude. It was later announced that perhaps the damage wasn't quite as severe as first thought, and since then we have seen the oil price coming down a bit, as you can see from the chart here, but the oil price does still remain above where it was last week. Now clearly for oil majors such as BP and Shell, they will benefit from the higher oil price, and therefore over the course of this week we have seen their share prices going higher. Now this episode has served to demonstrate to us that even though the world has made great progress in its move towards renewable power, we are still very heavily dependent indeed on fossil fuels and particularly oil. Now both the US and Saudi Arabia have blamed Iran for the strike on these oil refining facilities, and therefore that's led to a bit of concern about global tensions, or perhaps tensions in this particular region, and therefore we've also seen this week a bit of a renewed focus on defence stocks. And also this week, the Federal Reserve, for the first time in over 10 years, has been forced to inject more cash into the US money markets. One of the most important interest rates in the US is called the overnight repo rate, and that's the rate at which banks can lend money to each other overnight. The Federal Reserve has a target rate for this, and that's what's known as the federal funds rate. So banks in the US are required to hold a certain amount of cash on deposit, and on any given day, if a bank has too much cash, it can lend that to another bank overnight. If it has too little, it can borrow for another bank overnight. And that rate at which they lend the money is called the overnight repo rate, and if all is in balance, you would expect the overnight repo rate to match the federal funds rate. However, earlier this week we had more banks wanting to borrow than wanting to lend, therefore there was a funding shortage, and that caused the overnight repo rate to spike to over 10% before the Federal Reserve stepped in and provided more liquidity. So why have we had this funding shortage? Well, it's partly related to quantitative easing. So between 2008 and 2014, the Federal Reserve printed huge amounts of cash and used that cash to buy bonds. So every time it made a bond purchase, money was injected into the economy. Quantitative easing ended in 2014, but the Federal Reserve has been left with a huge number of bonds on its balance sheet, and those bonds continue to pay interest. When interest is paid, the Federal Reserve uses that cash to buy more bonds, so more money continues to be injected into the economy. In recent times, the Federal Reserve has reduced the rate at which it reinvests that interest into more bonds, and therefore we've seen a reduction in the amount of cash flowing into the economy in recent times, and that's thought to be one of the reasons why we had this funding shortage this week. Now, reducing the rate of reinvestment of these interest payments apparently has the same effects on the US economy as increasing the interest rate, and therefore the funding shortage this week is thought to be an example of the fact that the Federal Reserve is acting too quickly in reducing its balance sheet. Now today we have something called the Global Climate Change Walkout, where people all over the world will be walking out of their schools and offices and protesting about the lack of action on climate change. This has been an increasingly popular theme in recent years, even within the investment community. And over the last couple of years, we've seen hundreds of new investment funds being launched with the aim of promoting sustainability. However, this week, a number of those funds have come under fire for including investments that actually don't promote sustainability. For example, a number of these funds contain investments in fossil fuels. One example that was criticised this week was the SPDR Fossil Fuel Reserves Free Fund. So based on the name, you would expect that fund not to contain any fossil fuels. However, this fund does contain shares in RWE, a German company which owns a number of coal plants. Another example is the FTSE for Good index, which is an index set up to promote sustainable investing in companies that have good social, government and environmental characteristics. This index supposedly says it doesn't invest in coal, but the index contains shares in BHP Billiton, which is a very large producer of coal. The reason the index gives for containing this company is that BHP Billiton is classified as a general miner rather than a coal miner. So I think this just shows that if you are investing in any of these social, environmental or sustainability funds, it's really important to have a look at the criteria these funds are using in order to select their investments. Now, moving on to the week ahead, again, it's a fairly quiet one in terms of companies reporting, but we have got results coming out from Nike and Accenture. That's it from us. Have a great weekend, and we'll see you next Friday.